Awesome. So weird. I love technology. So all the questions are going to come up on the right side. Hello. Oh, I should hit play on this. Oh, there I am. I am live. Hello, everyone. How's it going? Um, my name is Marc Weinstein. This is my first time doing this on Stimulus TV. I'm super excited to be here sharing with you all. Um, I originally signed up for Stimulus to talk about one or two different, like very different subjects, and there's some overlap in terms of integrating uh, my personal life into the work world. But the first is yoga and the philosophy of yoga and leaning into some practices that we can do together, like breath work and new meditations and visualizations. Super important aspect of my life. Been practicing for almost a decade, or actually over a decade at this point, and I think it's really impactful for anyone that is struggling with stress right now, or anxiety in these times, or fear, to help you kind of clear. Oh, where am I streaming from? I'm streaming from France, over in Europe right now. I'm from Los Angeles. Well, I'm from New York, live in Los Angeles, and currently quarantined in France. It's on lockdown. Oh, Stim TV is doing breath work. I love it. Yeah, so we could do that. The other avenue that we could go down is the kind of economic situation evolving from the crisis. So my background is in finance and economics, worked in investment banking for a few years, went to work an undergraduate, started a financial services company after the financial crisis of 2008. Have a deep experience with that, and just love all things kind of broader markets, and would gladly share my thoughts on that front as well, which might get a little bit political. I have my views on the stimulus package and how funds have been flowing, share buybacks, things like that. Uh, I'm down for whatever. So let's get political. Okay, let's get political. So, so yeah. So where do we start? So we are in a current situation, in my opinion, where the the proponents of free market capitalism, who typically sit on the right of the political spectrum, are have evolved their framework towards something that reflects a bit more corporatism. We have massive concentration of income um, and wealth in this country. And part of that has to do with the unprecedented printing that the Federal Reserve Bank, or the central bank of the United States, has been doing um, in reaction to the financial crisis of 2008, or the Great Financial Crisis, GFC, as people are calling it. Why is that the case? Well, when a central bank prints money, um, this money has to flow somewhere. And typically, the way that the central bank prints money, it's actually all digital, is that they lower what's called the federal funds rate. And the federal funds rate is the rate at which a group of banks that are, pre-vetted banks are able to borrow directly from the federal funds window, or directly from the central bank of the United States in this instance. And when you lower that rate, arguably the demand for borrowing increases. Are we headed to another GFC? So just addressing that, I'll address that question in a little bit. I think that's a great question. I think we're in something that looks much different than the GFC. Banks in the United States are actually far better capitalized than they were at that time. But we're experiencing something far different because we have both a supply and a demand shock due to the coronavirus, meaning that our supply chains have been disrupted. We're going to have trouble getting necessary goods and services. And demand has gone down because nobody's buying anything. You're not going to the movies, you're not going to restaurants, etc. Not to mention that there's now 20 million plus unemployed in the United States. I think it's almost 25% of the US population have lost their jobs in the last month. There has been no period with this high level of unemployment since the Great Depression. And we all know how that turned out. And I think what's unique about this time around is that because of the prolonged financial crisis that's a good question, 32 to 35%. I'm not exactly sure I don't know the exact number of unemployment in the Great Depression, but we're getting there. I mean, and there hasn't been anywhere near this level of unemployment since. So yeah, we have severe unemployment, but what's different this time is that in the 1920s and early 30s in the Great Depression, a lot of the economic theories that have been developed today were not developed yet. And what that means is that the central bank of the United States did not have the ability to print what's called fiat currency, which is currency that is essentially backed by belief, the belief that the United States taxpayers will be able to repay any debt that the government issues in time. What used to back the United States currency was the amount of gold that was held in vaults of banks in the United States. We had a gold-backed currency. So your greenback was actually a representation of a certain weight in gold. Now, what happened in the 30s was what they call a deflationary spiral. I'm going to try to think about how I can easily explain a deflationary spiral. Assets lose value. So assets being real estate, assets being stocks or equities, which is just representation of ownership in a company. And as these assets lose value, people's perceived wealth decreases. And people don't have enough assets to cover the debt that they have. And if they can't pay their debt, they need to cut other costs to be able to pay that debt. So people and companies start to shore up their balance sheet by selling assets and cutting costs. If everybody in the market is a seller, there's not a lot of buyers, prices continue to spiral down. And as prices continue to spiral down, assets continue to decline in price, debt levels stay the same, more debt has to be repaid, more assets are sold, on and on and on. And as you can see, it's kind of this spiral downwards. It's called a deflationary spiral. This happens at the corporate level. This also happens at the individual level as companies are worried about their financial position. One tool that they have is to cut costs. And cutting costs in many instances is a euphemism for laying people off or firing staff or headcount reductions. As individuals lose their jobs and their income potential, they start to spend less. When they spend less, corporations earn less, and the spiral goes on and on and on. Savings get depleted, both at corporations and at the individual level. And it's just a really ugly situation that can happen over a prolonged period of time. These are kind of deflationary recessions. Deflation meaning the decline in asset prices versus inflation meaning the increase in asset prices. The mandate of the Federal Reserve Bank since that time has been to stop inflation. Now we have examples of inflationary or stagflationary challenges to the economy. One such example was the kind of oil and gas crisis, where, leading up into the 80s, we had I'm just going to pause there because I think I'm getting some questions and I want to answer those. Do I think that our generation can get through this? I think that our generation can get through this, but I'm really fucking angry, believe it or not. I don't know if you can tell. This is my angry face. I'm angry for a number of reasons. One is that when a government prints money, they do so by poker face. They do so often by borrowing. And when they borrow money, they essentially, as I said earlier, are saying that someone eventually will repay that debt in the future. And they're saying that they believe that the economy will grow to repay that debt. Well, who's going to repay the debt? It's millennials. It's Gen Z. That's the expectation. Eventually, the bill is going to have to be paid. So in a way, our existing institutions are leveraging our future to bolster their wealth and assets today to counter a deflationary spiral in asset prices. Why am I pissed? Well, those who would purport to be supporters of free markets would argue that risk management at the corporate level is the responsibility of corporate executives. It's commensurate to an individual having to save for a rainy day. You save, people say you should save anywhere from 10 to 20% of your income if you have the ability to do that when you're a young person. You do that because one day you might have a health emergency. God knows healthcare in this country is a disaster. You do that because one day you might have another kind of emergency where maybe you lose your job and you need to go without work for some time. Yes, I'll get to the specific implications. I'm trying to covering a lot of ground here. And this is the first, just so you all know, this is the first time I've spoken about economics like this in a public forum. So I hope that it's helpful, and I appreciate you sending over questions. So we are responsible as individuals to save for a rainy day. Corporations are also responsible, and corporate executives are responsible to save for a rainy day. Over the last 10 years, we've seen unprecedented growth in the prices of stocks on public stock markets. I'm going to just step back and try to explain what a stock is. A stock is just a certificate of ownership, a claim on a percentage ownership in a company. And that ownership gets you access to that company's dividends. If they ever pay out dividends, those are just payments to their investors. And it gets you access to that company's assets. If ever they liquidated the assets, you're an owner of that, you would receive payment. Now, these stocks, they trade on public markets, and the price of the stock goes up and down based on the perceived potential future returns to investors. That's basically, in a nutshell, what a stock is. Now, corporate executives have this since the financial crisis, the great financial crisis of 2008, we've seen unprecedented growth in stock prices. Stocks today are trading, or before COVID, were trading at around 30 times their average earnings. 30 times. To put that in perspective, the average since the inception of the stock market was somewhere around 14. So it was 2x the average. So stocks were, on a historical basis, they were overpriced relative to their earnings going into COVID. And that's not in and of itself, a positive or negative thing. But it usually, when something is overpriced, you don't buy more of it. So why were corporate executives over the last 5 years buying back unprecedented number of shares through corporate buybacks using the cash that they had on their balance sheets? They were doing it to send a signal to the market that they were going to reduce the share count of shares outstanding in their companies, thus raise the price per share, because there's fewer shares trading and there's equal demand for those shares, then the price will increase because there's lower supply. And I wish I had a whiteboard, but I'll use my arms. So you have your supply and your demand. My right arm is the demand curve. My left arm is the supply curve. As demand, and this axis is price, and this axis is volume. As the demand goes up for a product, the price goes up. As the supply goes down for a product, the price goes up. So when corporations buy back shares, they artificially increase the price of their shares using the cash on their balance sheet that they otherwise should have been holding for a rainy day, just as we as individuals are expected to save cash for a rainy day. Now, I don't necessarily blame the corporate executives for doing this, because they are held to quarterly earnings reports in a system that structurally cares about short-term gains over our long-term collective interest. And if they don't buy back shares and everyone else around them is buying back shares, they're going to be replaced by their board of directors for not benefiting their shareholders. So it's this game of, in order to keep up, you have to be buying back shares of your stock to pump the price of your stock number go up and get higher. Now, where did that leave us going into this COVID situation? Well, corporations thought they had a reasonable amount of cash on their balance sheets. Nobody was expecting a complete shutdown of the economy over a 1 month, maybe 2 month period. So those companies didn't have enough cash on their balance sheets to manage this crisis. Now, in unprecedented action, the federal government stepped in and offered support through a $2 trillion fiscal relief package. $500 million of the $2 trillion, or 25%, was allocated towards large strategic industries like airlines. Taking a breath. I encourage you to go back and look up how much equity, how many share buybacks there were at the airlines over the last 5 years. Now, where it gets really sketchy, in my opinion, is that the executives, typically CEOs and other C-suite executives, get most of their compensation through options packages. and these options packages become more valuable. Options are the right to buy a share at a given price at a future date. And so these options get more valuable as the price increases above the strike price or the exercise price of those options. And so these executives took the cash on their balance sheet, used it to buy back shares, increased the price of their company's shares, thus increasing the value of their stock options packages, leading to record levels of executive compensation in the United States in history. All the while, the average income for the middle class and lower class socioeconomically Americans didn't move over the last 10 years. I highly recommend this book by Tim Wu. I'm going to read some statistics from it. Tim Wu, it's called The Curse of Bigness. It talks about economic and political capture in our time, and it likens the current time period to that of the robber barons at the turn of the 20th century. So Vanderbilt, Rockefeller, JP Morgan, the masters of industry. I'm just going to share some statistics with you about the concentration of wealth and income in our country today. In the 1960s, the share of national income going to the top 1% of earners in our country had fallen to 8%. Seems like we figured out a way to solve the problems of inequality of the early 20th century. And the answer was a strong middle class. What we've seen has been a hollowing out of the middle class in this country over the last decade. Here's the numbers today. The top 1% of Americans earn 23.8% of the national income. That's earnings per year. But even worse, they hold and control an astonishing 38.6% of all national wealth. Where is wealth held? Wealth is predominantly held in the public markets. Only 20% of Americans own over 85% of the equity markets, or 96% of the equity markets. Fact check me on that. So, share buybacks, rich getting richer, executive compensation at all-time highs, free market capitalism. Great, go for it. Buyer beware, buyer of share buybacks beware, allocate capital at your own risk, and if a rainy day comes, pay the consequences through bankruptcy. We have a robust bankruptcy system in our country. But no, COVID crisis hits, and executives that had paid themselves hundreds of millions of dollars over the last 5 years, unprecedented level of CEO pay in this country, and an unprecedented gap between CEO pay and the average worker's pay, went to the government and said, we're going to have to fire our employees because COVID, this crisis, was totally unexpected. It was a black swan, and nobody would ever expect that we were going to go to zero revenue. Well, you didn't save for a rainy day. Now, I understand why the federal government steps in, but this is not capitalism. This is corporatism. This is close to fascism. We have essentially nationalized some of the largest industries in our country. Now, that would be okay if the gains of that nationalization were going to the taxpayer. But it's not the gains that are going to the taxpayer, it's the losses. So we have this heads I win, tails you lose game where corporations know that in any potential recession or depression, if they're of strategic importance to the national security of the United States, their excess risk taking is going to be bailed out. But when the boom times happen, they can pay themselves as much as they fucking want. And that is the truth of the situation that we're living in today. Massive unemployment, $1,200 stimulus check. I don't even think that pays 1/3 of your rent in New York City for a studio apartment. The Small Business Association loan program, the PPP loan program, was basically tapped out within the first week of it having been issued. And by the way, that was $350 billion versus the $500 billion that was earmarked for large corporations. And we know, we've seen how misappropriated it was, how much of it went to institutions like universities with tens of billion dollars endowments that they could have used to shore up their lack in cash flow due to the universities being closed. We've seen it go to large restaurant chains like Shake Shack. But the little operator, the mom and pop shop, the doctor, the lawyer, the plumber, didn't really get access to that. They're waiting in line still, but they have their $1,200 check. Oh, and their mortgage is not forgiven, and their rent is not forgiven, because God forbid the commercial real estate industry should have to suffer. And these are economic issues, but these are political issues as well. And so it's hard not to be politically jazzed up about this shit. Now, there's some other things that are happening that might be beyond the scope of this particular session, but some of you might have seen that just 2 days ago, the price of a barrel of crude oil in the United States actually went as low as, I believe, -$40 a barrel. See, that's beautiful that Sweetgreen just returned theirs, and Stanford just returned theirs, and there are enterprises that return their stimulus checks, and I think that's great, and rightfully so. But so for oil, we just saw the price of oil drop to negative. So you're like, how I can get a barrel of oil. I can't even fill up my gas tank for negative, but somebody will pay me to take delivery of oil. And the answer is yes. And the reason is because storage for oil is getting full, and there's not a ton of buyers for the amount of oil that continues to be pumped into the economy, because who's driving? Who's flying? There's so much more supply of oil than there is demand. And simultaneous to this, or just before the COVID crisis hit, there was a disagreement between oil delivery driver. I love that. There's a disagreement between Russia and Saudi Arabia, two of the largest oil producers in the world. Saudi Arabia leads OPEC, which is a cartel, meaning they set artificial prices for oil. And they do that by managing production. Russia's not a part of OPEC, but they're part of another broader group of oil producing nations that includes Mexico and a few others. And I forget what that organization's name is. Russia basically said, we're not going to stop producing. We're not going to scale back our production. And Saudi Arabia said, GFY, if you don't scale back production, we're going to flood the market with cheap oil and we're going to destroy you, because we can sustain prices lower than $25 a barrel for a very long time. and you'll have to close up your wells by that time because they just cost too much for you to continue to operate. And so we have this game of chicken between Russia. Ooh, how many countries distribute oil total? I don't know the answer to that question. But we have this game of chicken between Russia and Saudi Arabia. Neither of them have blinked. And we have a massive oil flooding the market, most literally, while there's zero demand for it. But bringing that back to the United States, I believe that the oil and gas industry in the United States represents 10% of our GDP, our gross domestic product, the output of our nation. Millions of Americans, I believe, millions, hundreds of thousands, if not millions. And I would love to be fact checked because now I'm just on a roll, but millions of Americans work in the oil and gas industry. And so those companies are going to go out of business because they operate in the framework of a for-profit business where they have to allocate capital in a way that produces returns for their investors. Whereas nationalized oil companies like Saudi Aramco and the oil company of Russia, whose name I'm blanking on, they don't need to have return generating economics, at least in the short term, in order to operate. And so with oil prices this low, we might see a mass of companies in the United States oil industry going out of business. And so the Federal Reserve Bank is going to step in and already have, in fact, by directly purchasing junk bonds. These are unsecured loans to high-risk companies directly from the market. So we talked about fiscal stimulus, which is the government itself, our elected officials and our executive branch, and the Treasury Department of the United States. We spoke about fiscal stimulus, the $2 trillion. We didn't speak about monetary stimulus, which is the Federal Reserve Bank of the United States, the U.S. Central Bank, stepping in to purchase assets to keep asset prices high and fight that deflationary spiral that we mentioned earlier. And they did this in an unprecedented way in the Great Financial Crisis. Ben Bernanke was a student of the Great Depression, and he thought that if the government had lowered interest rates aggressively in order to print more money, we could have gotten out of the Great Depression much sooner. And so in 2008, we had various programs, unprecedented programs issued by the Federal Reserve Bank of the United States to essentially to save banks and to save companies like at that time AIG, which is a large insurance company that insured a lot of very risky derivatives products known as mortgage-backed securities or collateralized debt obligations. And I really think maybe we should do an episode of definitions if we're going to do this again. But they printed. And so they set the precedent that there is such thing as too big to fail, meaning if the failure of a company is deemed to be a risk to the broader economy, the Federal Reserve will step in and buy the debt of that company in order to make sure that it doesn't go bankrupt, to stop contagion. And this, of course, leads to the moral hazard that we described earlier, where executives are able to take as much risk as they want, and they ultimately get bailed out. The monetary easing reduced interest rates to near all-time lows. Now we're at 0% interest rates in the United States, and I believe we'll actually go negative, meaning that you will have to pay the United States government to borrow from you. I love those terms, so if any of you want to lend me money and pay me to do so, I'm here. I'll send you my Venmo info. And we'll go negative for sure. But what that means is that the average American who doesn't have access to private markets, who historically hasn't had ease of access or understanding of public equity markets to invest, was screwed again, because the interest rate on your savings account is basically zero and has been for the last 10 years. So if you wanted to save for a rainy day, you wouldn't be able to earn any interest on the dollars that you're essentially lending to your bank by depositing them. They take your deposits and they lend them out 5 times, maybe more. You're earning no interest on your savings, and it's forcing you essentially to spend the dollars that you earn. And that's the intention of monetary easing, is to force consumption and to force investors to invest in riskier assets like stocks. And this has the effect of reducing interest rates across all debt securities and reducing return on equity of investments made into stock markets. So if you were a saver, you were screwed. If you invested in the stock market, you tore it up and you made a huge return over the last 10 years. But where we go from here, now that we've seen even more printing to the tune of around $6 trillion printed by the Federal Reserve Bank. Hi, Madam Rainbow Pants. I love your name. I can't speak to Canada specifically. I know that Canada does have a large oil and gas industry as well. Different national policies. Magic Friolita. So I'm gonna have to wrap up soon. You know, quantitative easing, monetary easing is a trap. Once you're in it, you can't get out of it. The Fed will continue to print. I believe we'll see negative interest rates. I believe we'll see more unemployment in the US. On the bright side, I think we are on a path towards universal basic income, because the political argument against it has become muted as people have received their $1,200 checks. Yeah, moving back to Venice would be fun. And I think we'll see a large fiscal stimulus package in addition to the relief package. And the stimulus package, it's my hope, will go into, it'll be kind of like a New Deal, maybe even a Green New Deal, and we'll go into rebuilding the rotting infrastructure of our country. We have some of the worst roads and bridges of any developed nation. Our education system is fundamentally broken. Our healthcare system is a wreck. It's possible that that stimulus package will go towards some of those things. Hopefully education, hopefully infrastructure, high-speed rail, and that investment will have a return to future generations, so to our children who are going to grow up in this country. And with that, I'll leave it for any final questions, any final thoughts. Thank you for those of you that tuned in. This has been a new experience for me. I've run out of oxygen. My throat hurts. I'm going to get a bigger bottle of water next time. Thanks, Sinbad. I'm in Europe for personal reasons. I had a trip scheduled here on March 8th, and then quarantine happened, and I just decided to stay. It's not to escape the United States. Professionally, I do a lot of different things. Right now, I'm actually leading business development at a company called Steward. One of our broken systems is the food supply chain. We're heavily dependent on industrial agriculture. We've seen large-scale farms actually having to mow fresh produce down. Dairy manufacturers having to dump rotting milk. meat manufacturing plants shutting down due to potential contamination. Steward is actually supporting the small local farmer who practices sustainable agriculture. And it's going to be the small local farmer and the rise of the tech-enabled farmer that I think helps bolster a resilient food supply for our country and fights the malnutrition that 20 million plus Americans face today. Support local for sure. Yeah. Yeah, happy to share more about Steward, and maybe we can get my CEO on here. Otherwise, I'm an executive coach. I'm a yoga practitioner. I've been studying yoga philosophy for about the same time I've been studying meditation, economics, apologize. And so I do one-on-one meditation and breathwork sessions, um, one-on-one coaching sessions. I've started 2 companies in the past. Very versatile, yeah. I'm a jack of all trades. Interesting quote. Jack of all trades, master of none. That's what most of us know, but actually there's a third sentence that's been left out, which is jack of all trades, master of none, though oft times better than a master of one, which I think is pretty cool. So for those of you that struggle with, I need to have one thing that I focus on in my life. Yeah, thank you. I have a podcast. My podcast is called Look Up. That last sentence is so key. My podcast is called Look Up. Look Up started to address, I created Look Up after appearing in the Fire Festival documentary. I wanted to address the issues that we face with social media and mental health and divisive politics. But I've expanded that to explore some of the topics that we discussed today, to explore philosophy and mindfulness and all that jazz. Yeah, fire. I feel like we're in like a fire festival type situation, except the taxpayers are bailing out the executives that fucked up. I was that guy, yeah. That's me. And so, yeah, that's my story. Yeah, and thank you all for your time. I really appreciate it. I appreciate the proactive comments, and looks like a lot of people tuned in, so it's pretty freaking cool. Thank you all.